The average cost in operational inefficiencies was $98 million a year. Now, obviously, some big institutions in there to have that type of cost. The number one thing was cybersecurity. AI and ML has really come into the fore to improve that process of bringing those documents from being analog to digital. So the technology's certainly changed, but the problem is still the same. The number one vulnerability is the people. You can have all the protection in the world from a firewall perspective, from a technical perspective, but if somebody in-house is ignorant of the risk, then there's a problem.
Generative AI will eliminate manual reconciliation by 2028.
False. There's too many different formats of data sets out there that AI can understand 100%.
Welcome to the Rate of Flow podcast. Today we're looking at what's keeping investment firms awake, from alpha dreams to ops nightmares. Hedge funds and asset managers spend millions chasing alpha, yet operational inefficiencies due to outdated or unintegrated processes are costing firms $11 million in average annual losses. Today we explore why reporting overload, cyber pressure, and volatile markets now outrank performance risk. Jon Hodges is a seasoned executive with over 20 years of global fintech experience in the markets. He's currently serving as the SVP and head of trading and asset services APAC at FIS, the world's largest fintech. Jon has a background as a startup founder, leader in a high-growth PE-backed business, and executive at a large global corporate. He's driven growth through product strategy, operational efficiency, and technology innovation. Jon, it's great to have you here today. Maybe to start off, let's get right into some of your experience in the past around this. Where was one of the first settlement challenges that you saw, either working directly for a hedge fund or working for hedge funds? And how did technology change the way that the organization looked at those challenges going forward?
Yeah, thanks for having us today. Thank you. So going back to where I originally started, my career was in hedge funds pre-financial crisis, who were trading the very products that eventually blew up in the financial crisis. So structured products, collateralized debt obligations, as they were called at the time, lots of underlying assets like mortgages, some loans, some derivatives, but pretty complex data structures. Things that we now know were probably more risky than some of the structured products are based on these days. So there was a lot of scope for operational errors to happen. There's unclear data, conflicting data, new products being launched, things that may be traded on a less liquid basis. And one of the features of these structured products is they have an effective date and they have a pricing date. So the pricing date is when they decide how much the structured bonds are going to be priced in the market for, and then the effective date is the date that the CLO actually closes or the CDO closes. So one of the things we saw was somebody got the effective date wrong, and some of the loans that were being purchased for this particular structured product were owned by another fund, and by having the wrong effective date, it meant that there was interest due on those loans that actually should have been payable to the purchaser, but because the effective date was wrong, the interest was payable to the previous owner. So you're relying on the good nature of a hedge fund or another kind of asset manager that used to own those assets to say, yes, we agree the date was wrong, we will pay you the additional carry that we owe you, which can be in the hundreds of thousands, if not millions of dollars, depending on the assets. So I saw in real time, firsthand, exactly how a simple mistake like that can have significant knock-on effects. I think that that was a relatively straightforward fix in terms of being able to put in the right validation rules, the right four-eyes processes with technology. At that time, we're talking, as I say, pre-crisis, so probably 2005, 2006, 20 years ago. Really just being a little bit more diligent around how that type of information is entered into the system to prevent that from happening. But I think it was a good example to me quite early in my career how a fat finger can have real sort of dollar consequences for companies like that.
How have those challenges changed over the past 20 years? Are they still the same issues, or we're just tackling them in different ways? Or what have you seen over the course of your career in terms of maybe the top three challenges then versus the top three challenges now from an operations perspective?
It's interesting because I think some of those challenges, particularly in that space, in the loan space, have not changed much at all. Loan documentation is still quite manual. The loan settlement process is still relatively manual. What has changed is some of the technology around digitizing that data. So we've obviously gone from faxes, emailed PDFs, manual entry into character recognition technology, some level of digitization and connectivity of systems, to today where people are using AI models, machine learning models to digitize those documents from PDFs still or from faxes still. I guess the obvious question is why don't we just digitize it at source and share it with everybody? And there are companies trying to do that in the loan space. But the problem with that is coverage, because you have to have all the participants, all of the loan originators, all of the loan agents agree to use the same underlying technology. And the one that I'm thinking of, without naming any company names, but the one I'm thinking of actually uses a blockchain technology. It is funded by most of the agent banks in the US, actually. So they do have good coverage, but not complete coverage. And so there are still pockets of faxes, pockets of PDFs where we still need that digitization piece. And that's where AI and ML has really come into the fore to improve that process of bringing those documents from being analog to digital. So the technology's certainly changed, but the problem is still the same.
Does the technology, though, in this case, does that obviate the need for having consensus around one particular way of loan origination? Like, I mean, to a certain extent, if you don't have 100% coverage, but whatever coverage is not there is being handled by AI, then maybe that's good enough.
Yeah, it is. I think it's just that because the originators of the loans have the let's say the majority or a majority of data on those loans that they can distribute digitally, as we talked about. But then you've got everybody trying to do that AI piece, right? It's not coming from one source. So you've got hundreds of participants receiving a loan document. All of them are trying to digitize that document in some way or another. So you've got different levels of accuracy, different techniques, and it's kind of an operational overhead that should be centralized. I mean, there are people. I mean, FIS has a business that does this, but there are other people like that too that are trying to provide outsourced services so that they can be that one vendor and probably focus a bit more and spend a bit more money on the technology rather than having the asset managers do it themselves. But at the moment, a lot of them are still doing it themselves. It's kind of like I guess back in the days of everybody used to do their own fund accounting, right? And then now over time, that's obviously become more and more outsourced, and very few people do their own fund accounting, maybe for shadow reasons, but not anymore. So I'm sure that will change, but at the minute, there's a lot of micro industries, I think.
I mean, it's effectively a hidden cost stack, right?
It is.
In many of these organizations. You hinted at a couple of these things, but in your mind, what silent killer, let's call it that, erodes margins faster? Is it compliance bloat? Is it data quality rework? What do you see as the biggest challenge that is really hurting the operational efficiency and cost effectiveness of the firms?
So we commissioned a study with Oxford Economics recently called the Harmony Gap, and one of the things we focused on was those hidden costs in the stack. It wasn't just on asset management, it was across financial institutions. So everywhere from less than 2 billion right the way up to over 20 billion in assets under management. The overall, across that group, and there's over 1,000 institutions or executives that were spoken to, across that group, the average cost of all of these hidden costs in operational inefficiencies was $100 million a year or $98 million a year. Now, obviously, some big institutions in there to have that type of cost. The number one thing was cybersecurity. But after that, it was regulation, operational efficiencies, and there's a whole list of other items that continue to do that. So I think cyber is, of course, potentially super risky from a loss point of view, because it's not just an operational inefficiency; it's actually a risk of monetary loss, right? But not far behind that, you've got regulation. So one of the things we found was that in the last 10 years, since 2014, there's an additional 2,000 data fields that firms need to capture for regulators. Now, maybe not every firm needs to capture 2,000, but you start to put that across the industry. That's a lot of work that needs to be done. That's a lot of systems that need to be changed. That's a lot of reports that need to be delivered. there's a lot of overhead that you don't necessarily see. And then the operational efficiency bit comes after that, and there's obviously manual errors that can come into that. But I think just thinking about that regulation point is significant.
Different regulators as well.
Different regulators, yeah.
What of those results, what surprised you, and what do you think surprised FIS's clients? Is there anything that stood out as you didn't realize that this was such a big problem?
For me, that was one, actually, because I think that sort of crept up. For me personally, that's crept up on me over time. There's been, of course, as a technology vendor, sometimes we really like regulation because it gives us a reason to add value for our clients, to talk to our clients, to understand their workflows, to help them maybe reimagine operating models and how technology can help them get to where they need to be. I just hadn't necessarily quantified it because it's happened over a decade, and so that for me was the biggest surprise. Yeah.
You mentioned cyber. Where does that sit in terms of priorities for the average COO at a asset manager these days?
So that was pretty much the top
number one,
from what we've seen. Yeah, the cyber security, the resilience, being able to have highly available systems that are secure was kind of table stakes for all the people that, not all the people, but the majority of the people that were part of this survey, and most of the people that we speak to as well is such an important part in today's world. Because when you start talking about more advanced topics on AI, on bringing huge data sets together from disparate systems and everything else, all of that relies on having that resilient, underlying, stable stack. So cyber is up there for everyone. Yeah.
Yeah, it's many of the cyber criminals have access to the same tools, so they're moving as quickly as some of the firms themselves. Sticking to cyber for a second, from a non-technical perspective, we'll talk about the technology in just a minute, but from a non-technical perspective, what has changed in the way that like a COO would look at cyber from a non-technical, like in terms of their process and their approach to ensuring cyber resilience?
Yeah, so my experience of it, and going back to, I guess, the hedge fund days was, back then people had their own servers in the cupboard, right? So the cyber was more like you weren't allowed to take disks out of the building. You weren't allowed to plug USB sticks into it. And then there was a period of time where obviously things became much more connected, and it was about firewalls and penetration tests and everything else. But most recently, from what I see, and certainly the training that I do and we have to do, is the number one vulnerability is the people. So whether that's malicious links, phishing, that type of thing. I think we the people are still the number one weakest link, and that's where CIOs are still very much focused, because I think you can have all the protection in the world from a firewall perspective, from a technical perspective, but if somebody in house is is either determined to do it or just ignorant of the risk, then there's a problem.
Yeah, that human element is usually the biggest weakness. You mentioned regulators before and regulations. Which specific rule or set of rules is really taking a lot of the time from our operations teams right now? Is it around technology risk? Is it around other kind of compliance elements or reporting elements? Where do you see the biggest drain right now in terms of people hours?
So most recently, there's this sort of raft of regulations globally. So Europe is DORA, Australia is CPS 230, MAS have I think it's TRM, is it called TRM? All of these are pretty broad: operational resilience, technology resilience, cybersecurity, how you deal with vendors, how you deal with employees. Some of them are a little bit vague, I think, from what we've seen, and they're open to interpretation from the financial institutions that they're governing. That's taken a lot of bandwidth. Every time, for us as a vendor, every time we're negotiating a contract, there is conversations about some element of the regulation, how to interpret it, where does the risk lie? Does it sit with the vendors? Does it sit with the institution? So I think for me that, and again, I guess it stems from the cyber piece, right? But it also includes operational resilience and technology resilience too. So that for us has been a big feature of a lot of the conversations we've been having.
How would you quantify that? I mean, if you look at like basis points of alpha that firms are losing to this ops drag, I guess you might call it.
Yeah, it's hard to put basis points on it. I think we did have that on our stats here as well, actually. Regulatory issues. So they're saying of that $100 million a year, they're saying $15 million on average across these institutions. So 15% of the overall friction in the system is coming from regulatory issues. Mm. So, hard to say on a basis point of view, I think, but I think that's a useful indicator.
We've talked a lot about kind of the operational challenges. Now let's talk about the solutions and potentially what technology could do. Can you give us some examples in your experience with working with clients about where, say, a cloud-native PMS or OMS upgrade has paid back in a period of time? I mean, what examples can you bring from your experience of where clients have really leveraged technology to get a payback and to increase that alpha and be more operationally efficient?
Yeah, I mean, obviously we like to think we've helped many clients do that with the projects we've worked on across lots of different areas, front, middle, back office. I think the cloud-hosted PMS, OMS, or cloud-hosted technology in general is, you have to dig into what that means, right? So I think there are legacy systems that have been there a long time that are cloud-hosted. All that means is that somebody somewhere has taken that system and put it into a cloud. It could be sat on a server in somebody's back cupboard in the same way as it used to be. It just happens to be in AWS or Azure, right? So does that really help the customer? It depends. I guess it helps from an infrastructure point of view, maybe from a cybersecurity point of view, from resilience, etc. But does it really help leverage the cloud in the way that people think about the cloud? So I think you have to be quite specific about the implementation in the cloud. We've definitely seen cloud native technology help our customers in a big way, particularly where they need scalability. We have insurance clients that do a lot of the actuarial work. They need that horizontal scalability with their products. We have converted some of our heritage solutions to be cloud native, to be able to leverage some of that technology, and that has really helped transform not only their engagement with us, but their cost base as well from a compute perspective, whereas previously they were kind of having to purchase upfront a fixed cost of compute. With that type of technology, you can obviously flex it up and down as you need it, month end, quarter end, whatever it might be. So certainly from that perspective, we've seen lots and lots of benefits. But I think the key thing, if you're going to think about how technology can help, is having the right data strategy is really important, because that can help make you vendor agnostic and help make you technology agnostic. If you can really think about how you want your data to be structured, you're always going to have a big ecosystem of providers. Some of it will be from one vendor, some of it will be from service providers, fund administrators, whoever it might be. Having the right data strategy internally is going to be the platform that you can then use to put the right systems in place, leverage cloud if you want to, offboard or onboard from vendors too, right? Which is important as well. So I think one of the main things that we're hearing from people is like, how do we get that data strategy right so that we can put the right tooling around? And it's not really just about a functional piece of it, which could be an OMS, could be a PMS, could be a fund accounting, could be, a risk system, whatever it might be. But if you haven't got your data right, it's difficult to leverage the modern technology.
When you look at data with your clients, what are kind of the top 3 fixes that most of them could look at to have the biggest ROI, like immediate ROI on how they're approaching data?
Normalization is the first one, just having the ability to have lots of different sources of data that you can normalize into a schema that makes sense for you. So that obviously includes having some level of data management overlay, which allows you to map different data sources. There's probably some element of reconciliation in there, which is, can be driven by AI these days in terms of the rules. And so I think that's really key, is the normalization bit. Availability, so making it available through APIs, making it accessible to other people in your ecosystem, whether that's investors, whether it's technology providers, whether it's service providers. We've seen things like Snowflake make that much easier than it used to be. So being able to federate data sets within one instance of Snowflake to another one, I think has been super helpful and useful. And Snowflake's not the only one to do that, but it's obviously one of the bigger ones in financial services that people are using. So making it really available, having it normalized, and then accuracy. So that whole data pipeline of data in and data out, like where's your validation, where's the reconciliation, how are you doing your QC and QA over that? I think they're the three sort of pillars that we're speaking to our customers about.
What is preventing customers from moving forward on those? Are there blockers? Is it cost? What are the challenges that they face that keep them from moving forward on addressing these?
I think cost is obviously part of it, taking on new technology, skill sets as well, like having the right people in-house or, from a vendor that understand all of their data sources and are able to really put that together. I think that's improving. There's more out there now. We certainly have products that we're offering to people, and there's other vendors similar to ourselves that are doing similar things. So I think the skill set's there, but the cost there's an upfront cost to it, right? And I guess it's one of the hidden costs that we spoke about, is it does have an ROI, but if you look at it to begin with, it's probably quite a big cost. And if you're thinking about having operational efficiency, you don't often get that without some upfront investment in people and in technology. So yeah, I think cost is a big part of it.
Of all of these things, I mean, you mentioned AI reconciliation and it's obviously a big buzz right now in the industry. What KPIs for clients have moved the quickest when they've implemented something like AI reconciliation? What have they noticed as the ROI or the KPI change and shift after?
Yeah, so we implemented AI into our reconciliation tool 2024, I think. So we do have some first-hand experience of this. So what our AI tool does, maybe not everybody's, what it does is it suggests rules, or it creates rules, matching rules as data changes. And I think that's been, if you look at reconciliation generally, that is certainly one of the problem areas. So you have teams of people, or you implement a reconciliation tool for someone. You set the rules up for the data as you know at that time. Let's say you get 80% matches, 20% is exceptions. Over time, those files obviously change. There's different data sets, there's different providers, different, counterparts in the system. Unless that team in-house knows how to keep those rules up to date in the right way, then generally what you see is that those matching rates go down. So they start at 80%, they can end up, maybe 50%. And that's just maintenance. And that's usually maintenance because there's probably a skill gap that the vendor who implemented it had, but the people who are operating it maybe don't have. And that's the gap that we tried to close with AI. So I think you probably hear that. I think the question was, those metrics that you hear, we get an 80% match rate, we get a 90% match rate, but how much of that is done automatically and how much of that is done by a bunch of people checking it, every day? So I think that's where the AI bit is coming in, is trying to close that gap. So really, ideally, operations should be an exception-based process, like the whole thing. You really should be dealing with exceptions, but too often I think people are actually dealing with the 90% still. That's
a really good point. I mean, there's a lot of talk about how everything is STP and automated and all of this, but in reality, what is kind of the biggest real-time ops claim that you've seen that in reality is a couple of people with a spreadsheet behind the scenes?
There's quite a lot. So I think there's obviously massive increase in private credit over the past 10 years, 15 years. Still super, super manual. There are, settlements within that world on the loan space where people are still having to speak to each other on the phone. As I said, they're still receiving documents either by fax or by PDF. And yes, there's some digitization in there, but there still has to be, where there is a potential mistake, where there's a break, there still has to be a conversation between two people as to, is that the right rating? Is that the right price? Did it mature that date? So that's still going on. And then I think, you've also got just the whole private credit world in terms of the loan agreements as well. So you and I can enter into a loan. It can be completely different than any other loan that ever existed. I need data from you on a periodic basis to make sure that I'm still comfortable to loan you that amount of money. There's a lot of manual work in that as well, because there just isn't really a standardized way of digitizing that yet. So there's a lot of effort going on and there's a lot of advances in it, but I still think when people say straight through processing and private credit in the same sentence, it's Probably, probably not.
You stand a bit skeptical, I guess, of the.
Yeah.
I mean, regulators are kind of guiding a lot of this, guiding or depending on what word you want to use, if it's guiding or impairing otherwise. But a big topic has been operational resilience from the global regulators as a board level duty. Where do most firms fail in that test? Where is the weakness that most firms have to deal with when they have to meet the requirements from regulators around operational resilience?
I could, without naming examples, although those they have been in the press, right? It's generally around reporting. So they're not able to understand the activity of their own, let's say, trading desks, in an example that I'm thinking of, to be able to report properly on what they should be doing. So short selling, for example, there's been a lot of press about a large institution in APAC in the past, quarter or 2 quarters, who have been fined a lot of money because they didn't report their short selling activity properly. I mean, you would think institutions of that size would have the budget, the skills, the expertise to be able to put the systems and all the processes in place if they don't have the systems to do that properly, but they're still getting caught out. And there's lots of examples of that across the board, right? When it comes to the hedge fund space, I think you've seen that where they haven't got a handle on their risk. And I think the stat at the beginning was 50% of hedge funds have failed because of operational problems. I think that's one of them, is not having a handle on the risk properly, because you haven't got the right operational processes can be fatal for a hedge fund that is of a smaller size than a large bank. So I think that's really it, is like really understanding what is happening from a data perspective and being able to report on that. Not just for the regulator, but from a hedge fund perspective, you need to know that to be able to stay alive. Obviously, from a regulator perspective, you need to know that to stay compliant.
What do you think is the most under-discussed operational risk? What should firms be talking about, but they're not talking about or don't realize?
I actually think it's expertise in the operational teams. I think that perhaps there's I think everybody thinks that AI and machine learning and technology is going to take out a large portion of the operational workflow. And I think that's probably true. Well, it is, it's going to happen. But in order to make that AI successful, you need the people that really understand the industry, that have been there and done it and have made the mistakes and have fixed the mistakes. And I think losing that expertise is something that people don't really talk about. Like, are we attracting the right talent into the industry? Are we creating an entry point for that talent? Because by putting the AI into it, the first thing that often goes is those entry level positions. And are we therefore creating the right, the escalator up to make sure we've got people in 10, 15, 20 years time that have the right experience to be able to understand what the AI is doing if it doesn't work. So I think that's a risk that is not talked about enough, because it's the obvious cost saving for companies across the board is to start reducing those entry level positions. But then how do you ever then have the mature expertise that we've relied on for so long?
That's a really good point. I remember at my time at Citi, the head of risk management and operations was a guy with 30 years of experience in the industry, and he knew exactly what was going on all of the time. But if he hadn't grown up in that environment, he would have never been able to address some of these things. So it's almost an over-reliance on AI that over-reliance on AI in a certain respect of, maybe it's doing too much for us, but even from the talent perspective, it makes a lot of sense.
Yeah.
If you were looking at one of your clients right now and you had a budget of, say, $10 million to spend on addressing some of these challenges, how would you split it between people, process, and tech? What do you see from clients today, and what do you think is the appropriate allocation?
So I think you have to be holistic about it. I think that the trying to digitize a analog process is still an analog process. So I think it is really, some part of it has to be, let's really think about the operating model and the target operating model and the technology that we think we can use and what that can bring to us, rather than just saying, look, we've got a 10-step process. We know we can put it into the cloud, or we know we can digitize this step. It's like, well, maybe a 10-step process should be a 2-step process, right? So I think that operating model bit, so the process bit, is significant, particularly up front. There should be some significant investment into that. And then choosing the tech that enables that is really important. And then from the people side, I think hiring people, we spoke about their expertise, and you need expertise in the operational side, but hiring people that have that technology slant, like one of the things that we do in FIS, we've started this, it's called a community of practice. So across it's 50,000 people in FIS. It's a big organization, right? So there's going to be lots of people in there that play with AI in their spare time. Maybe they use it in work where we have Copilot. Maybe they're doing projects that are specifically there for it. So we've put together these communities of practice, which is to try and get these people from different parts of the organization using AI, or maybe they're looking at process improvement or whatever it might be, bring them together periodically and just share ideas and learn from each other. So I think that's that on the people base. Yes, you need experts in what you're trying to hire for, but try and encourage that technology slant, because it's going to become more and more part of the toolbox for everybody, right? So
knowledge management has been part of the industry for decades.
Yeah.
But it takes on a new meaning, I guess, in this AI environment.
Yeah, exactly.
Going into a section now called the myth or reality or lightning round. So the idea here is I'm going to give you a statement, and then you give me a quick answer, true or false, and a little bit of rationale for that. Generative AI will eliminate manual reconciliation by 2028.
By 2028, false.
Why?
I think there's too many different formats of data sets out there for us to confidently say that we're going to have digitized it, mapped the data into a schema that AI can understand 100% and provide answers for. In 3 years. That might happen, but 3 years seems aggressive.
Cyber is now a bigger threat to hedge funds than market volatility. You could say pre-Trump and post-Trump.
I was going to say. I'd say it shouldn't be. Probably depends on the hedge fund. Yeah, it depends on the hedge fund. For some, it is. For some that have got their act together, it probably isn't. But it shouldn't be in this day and age, is the answer.
This one will be close to home, I think. Ops alpha will matter more than strategy alpha within 5 years.
I think that's possible. I think there is a lot of the whole asset management industry is more and more based on speed and accuracy. There's huge inflows into ETFs and all these positions that are like super crowded out now. So I think being able to have operational efficiency that gives you that speed and that accuracy that then allows you to make better investment decisions more quickly, it could be equally as important. Yeah.
And last one, we've avoided this topic, but it has to be up with everything that's happening is stablecoins. Stablecoins plus instant settlement make NAV errors obsolete. Fact or fantasy?
Over a timeline or anytime? A fact at some point, probably. Yeah.
Now moving on to the last section of the podcast here, just looking forward into the future, when you look at your 2030 ops control room, whether it's virtual or physical, what screens, alerts, or job titles disappear?
So I'm not sure about the job titles that disappear. I think the process by which operations and compliance or oversight is kind of melded together. I think that's what changes. I think operations, compliance, oversight, regulations, they all merge into one, because the more real time and the more tech enabled you can be internally, and the regulator as well, the more real time we can spot potential risks for an individual participant in the market, or even systemic risks that are happening, across all the participants. So I think perhaps it's more of a merge of those roles, like the compliance roles and the operations roles. Maybe they don't exist in the exact same form they are now, but that whole piece becomes more of an operational piece, because if you get the real-time monitoring right, then I think that helps the whole system.
Everything else falls into place. Let's give the listeners some homework. When they get into the office the next day, 9 a.m. tomorrow, whenever they're listening to this podcast or watching it, which tasks or which opportunities should they be looking at first? What should they be doing to get more alpha from their ops? And
I think it comes back to that point. I think you should be mapping out the process you have now and thinking about what it should be with the technology as you know where it is, and then finding the vendors that can give you that technology to make that happen. So I would say, map out your current operational process. Don't just reimagine it as a digital process that's exactly the same, but reimagine the bits that technology can take out for you, and then find the vendors that can solve that problem for you.
It's a good way of looking at it. Jon, thank you so much for being with us today. Really enjoyed the conversation.
Thank you. Appreciate it.